economist from the SEC's Division of Economic and Risk Analysis, or DERA, as it's colloquially referred to within the agency. Although I'm no longer a member of the team, having stepped down as chief economist, returned to Vanderbilt this past May, I believe that I'm still allowed to offer a blanket disclaimer on behalf of my former colleagues. Specifically, no presentation by an SEC employee is allowed to proceed without noting that the remarks do not reflect the views of the chair, commissioners, or any of their colleagues at the commission, and are their own. So now, having dispensed with the formalities, I'd like to kick things off by introducing the panelists and their respective topics. These discussions will track two primary areas of responsibilities of economists within the commission: economic analysis to support rulemaking, and risk assessment and data analytics. One of the common themes that will emerge from today's discussion is the important role that academic-style research plays within the conduct and the execution of staff responsibilities. As evidence of this, I'd like to encourage everybody to take a look at DERA's website, where you will be able to see staff white papers, working papers, and a listing of peer-reviewed publications. I think it will quickly become apparent that DERA is a place where high-quality academic research is conducted, as evidenced by the placement of staff research in top-tier finance journals. Now, every rule at the SEC that the SEC promulgates is required to include an economic analysis that discusses, among other things, the effects on efficiency, competition, and capital formation. These requirements all require or demand a broad understanding of not only the rule's likely economic effects, but also a clear formulation of the current baseline. The SEC satisfies this broad requirement by providing a qualitative discussion of the important economic considerations, and when possible, to provide qualitative discussion about the analysis that supports the views of the commission. And I think one of the typical approaches used to satisfy this obligation is to apply standard financial economic modeling to financial data. Now, Vladimir, to my immediate right, will discuss some of the analysis he's worked on to support the Jumpstart Our Business Startup Act, or the Jobs Act. Vlad is a senior financial economist in the Office of Corporation Finance within DERA and has been at the SEC for over 5 years. He has seen the role of economists significantly expand during his tenure, evolving from the former Office of Economic Analysis to a full-fledged division. The Jobs Act is a mandatory rulemaking that is designed to enhance capital formation by, among other things, providing firms with greater access to private capital through new channels such as crowdfunding, and allowing firms to reach more potential investors by lifting certain bans on general solicitation. Vlad will discuss a staff analysis that documents the amount of private capital raised through Regulation D offerings. Using data that issuers are required to submit to the SEC in a structured data format, he will show that the size of this market is surprisingly large and active. Our next panelist will focus on another aspect of the Jobs Act. Amy Edwards is the Assistant Director of the Office of Markets and has the longest tenure of anyone on the panel, possibly even in the entire division. She is a recognized expert on market microstructure and will be discussing a new tick size pilot program that stems from a congressional mandate for the SEC to consider whether equity capital formation was being adversely affected by decimalization. The original idea was that penny ticks may have made it too costly to retain sell-side equity analysts, and as analyst coverage declined, it became harder for firms to IPO because it became increasingly difficult to attract investor attention. Whether you believe this story or not, I personally do not, it has spawned a tick size pilot that will possibly explore, among other things, the impact of increasing the minimum tick for emerging growth companies to 5 cents, and give the SEC an opportunity to study the effects on liquidity in markets. Now, the Dodd-Frank Act is another example of mandatory rulemaking that the Commission has been working hard to promulgate. As you are well aware, the Dodd-Frank Act is the principal regulatory response to the financial crisis. This rulemaking was in full swing when I became chief economist over 3 years ago and continues even today. Igor Kozhanov is a financial economist in the Office of Corporate Finance. Igor's been at the Commission a little over a year and we'll be discussing some of his analysis used to support the Asset-Backed Security Disclosure and Regulation Rule, or Reg AB2, that went final in September of this year. Without putting words into Igor's mouth, my view is that the primary purpose of Reg AB2 was to resolve some of the adverse selection concerns that surround the issue of the issuance of asset-backed securities. The rule requires and standardizes asset levels disclosures so that potential investors can evaluate the riskiness of the underlying asset pools that they would consider investing in. Since Dodd-Frank also requires the removal of specific references to credit ratings, this provides investors with the information one would need to perform independent valuations. This provides a nice transition to our next speaker, Tara Bhandari, another financial economist in the Office of Corporate Finance. Tara also joined the SEC a little over a year ago and will discuss some of the Commission's current initiatives related to credit rating agencies. Credit rating agencies have received a lot of attention lately, but they are of particular interest to financial economists because they provide a useful setting for research related to many key questions, from principal agent models to percolation of information in markets. And there are many interesting changes taking place now. Tara will spend a few minutes giving a quick overview of the status of the rating agency regulation and then delve deeper into some of the challenges the SEC faces in this area and related questions on where further academic research will be helpful. Our last speaker will talk about some of the non-rulemaking initiatives that are housed in the other half of DERA. Scott Boggess is the Deputy Director and Deputy Chief Economist at the SEC. Scott started at the SEC as a visiting scholar in 2007 and now oversees, among other things, DERA's risk assessment and data analytic initiatives. Although it does not yet have the same visibility as DERA's efforts to support rulemaking, I view the expansion of these capabilities as really the single most exciting development at the SEC today. It merges SEC efforts to better understand the behavior of registrants with a set of econometric modeling skills that are really a part of every financial economist's toolkit. It is an example of the type of expertise that economists are uniquely suited to provide and has the potential to provide the rest of the Commission with tools that will allow them to perform these tasks in a targeted and hopefully more efficient manner. Scott will describe a number of our past risk assessment models. These range from the aberrational performance inquiry model, which was designed to identify outlier returns among hedge funds, to the accounting quality model, which attempts to identify the determinants of a firm's use of its discretion when reporting financial performance. The plan for the remainder of the session is for each of the panelists to deliver their prepared remarks, and then with the remaining time, we'll open the session up to a Q&A period. So without further delay, let me turn this over to Blond.
Thank you, Craig. As Craig mentioned, the Jobs Act introduced some significant changes to the market for private offerings. For example, a year ago, we adopted a rule that allows issuers to generally solicit and advertise offerings to with basically anybody, reversing an 80-year practice of the SEC. We are working now on regulation crowdfunding that would allow companies to approach investors directly over the internet to raise funds. There is also going to be a change in another regulation, Regulation A, that allows companies to issue securities in a private offering, and those securities can be traded immediately after that, or they become liquid right after that. So as part of our work on the Jobs Act, we undertook a study to examine how big is the private offerings market, and to see what are the main players, how often intermediaries participate in it, and generally how the changes mandated by the Jobs Act would affect this market. As you all know, not much in terms of academic literature has focused on private offerings. The existing studies focus actually on private offerings by public companies. But we don't know anything about the pool of companies that use this market and how big this market is. So that's what we set out to do, using a particular exemption called Regulation D, which allows companies to, if they satisfy certain criteria, to raise funds in a private offering. What turned out was pretty interesting for us, for the Commission, and also showed how large this currently unstudied market is. So we found out that issuers raise approximately $1 trillion per year in terms of private offerings. Okay? That dwarfs the market for registered equities. Okay? It also is much bigger than the market for registered bond offerings. If you look at the composition of the issuers in this market, the majority of deals are done by small non-financial companies. Okay? So they tend to do a lot of small deals and tend to use this market very frequently. So we have our data from 2009 until the end of 2013. Issuers were required to file electronically. They file a Form D, which we use to collect the information for these types of offerings. When you look at the composition of the issuers in this market, the largest chunk of money has been raised by funds. These are hedge funds, private equity funds, other pooled investment vehicles. Funds tend to have fewer but larger offerings. The median offering size for a hedge fund is $100 million, whereas the median offering size for a non-financial company is about $1.5 million. In terms of number of unique issuers, what we discovered is that over 25,000 unique companies have used this market for the last 5 years, which is, when comparing to the public market, it's quite significant, quite large. Issuers tend to rely on exemptions that preempt state securities laws. As you might know, if a company wants to issue securities, these securities has to be registered with us, or they have to find an exemption. Also, they have to register these securities with the state security authorities. Okay? So issuers tend to use Reg D exemption that allows them to avoid state security regulation. In addition to that, the number of intermediaries, participation of intermediaries in this market is quite small. Okay? If you look at IPOs or bond offerings or season equity offerings, there's always an underwriter in these types of offerings. In private offerings, only 1 in 5 offerings has financial intermediary present. Okay? So very different from the public market. Intermediaries are mostly present for larger offerings and offerings done by hedge funds. Okay? Non-financial issuers rarely use intermediaries. Regarding the cost of intermediation in this market, the average commission that issuers pay is about 6.5%. You can compare this to the gross spread for IPOs of roughly 7%, or the cost of season equity offerings and bond offerings, which are about 1.5–2%. Right? So cost of private offerings in general we find much higher than the cost for public offerings, expected, and also cost varies with the size of the offering. Smaller offerings for up to $1 million, right, have on average commissions of about 7.5%, whereas large offerings for over $50 million, have commissions for about 1.5–2%. Another issue that was interesting for us was the participation of investors in this market. Right? Usually private offerings are geared towards more financially sophisticated investors, what we call accredited investors. Very few offerings tend to involve retail investors. Okay? For example, in this space, in this regulation deep offerings, only 1 of 10 offerings has participation by a retail investor. Okay? It's usually 1 or 2 retail investors. majority offerings are geared towards what we call accredited investors. About 250,000 investors tend to participate annually in these offerings, in private offerings, where the number is not that accurate because we don't know the identities of these investors, so we should double count some of them if they participate in multiple offerings. But this to give an idea how investor participation in private offerings compares to investor participation in public securities. Another interesting finding that we documented about this market tends to move in sync with the public markets. Some people have argued that when public markets are down, investors would shift to private offerings to raise capital. We did not find evidence of that. We found that the number of offerings in the private market, the regular market, moves in sync with the S&P 500. Right? So follows the peaks and troughs of the S&P 500. So it doesn't seem that this market serves as a fallback for investors when the public markets are shut down. As I mentioned, recent regulations have made significant changes in this market. Right? So since last September, issuers that do a Regulation D offering relying on exemption 506. This is the exemption that allows issuers to raise unlimited amount of capital, but target only up to 35 retail investors. Everything else should be accredited investors. And this is the rule that exempts these offerings from state security regulation. So this is the rule that is used by 94% of the issuers, even issuers that qualify for different rules. Now, if you do a 506 Reg D offering, you can advertise to anybody. Okay? And then the requirement is that you sell only to accredited investors. And also that issuers, companies that raise capital to receive exemption, screen the investors to make sure they're accredited. Okay? So what has happened in this past 1 year since the adoption of the rule, surprisingly, not much capital has been raised through this new exemption. Okay? Why? And again, the difference is in order of magnitude. Right? To give you an idea, only about $25 billion was raised in these offerings with advertising compared to $1 trillion in the traditional Reg D offerings for last year. Some of the reasons are that funds that are governed also by other regulatory agencies like the CFTC have to abide by other rules that prevent the use of general solicitation. And also there is some legal risk on the part of issuers that tends to do with the uncertainty how to verify that the people you sell to are accredited. So that we think tends to currently limit the use of this rule. And going forward, once the Commission adopts the regulation crowdfunding, we'll see a big change in the way small firms raise funds to private offerings. Because after crowdfunding is adopted, any small firm, any firm actually, will be able to advertise to any investor and to sell to any investor, not only accredited, anybody. Although there are limits on how much they can raise, but that would lead to a significant change in the way small firms raise capital, which we're excited to see how this regulation works out and what are the consequences for small firms. Would they be able to tap currently unused resources? So with that, I will turn it over to Amy.
Thank you. So I'm going to talk a bit about the upcoming tick size pilot, and Vlad is actually leaving to go to another session, but at the end of the session you will still have a chance to ask questions on private funding, because I think Craig and Scott can answer those questions. Anyway, on the tick size pilot, so Craig mentioned that this came out of the Jobs Act, or had its inspiration from the Jobs Act and looking at the ability of small companies to raise capital. The tick size pilot itself is not designed to allow you to study whether small companies can raise capital more easily or more cheaply. Instead, we're a few steps removed from it. The main point of the pilot is really to look at market quality and see how increasing the tick size affects the market quality of these small stocks. Most stocks in the U.S. trade in a 1 penny quoting increment, and that's really almost a one-size-fits-all answer. And so this tick size pilot is meant to question that one-size-fits-all action, see if some small companies would be better off. As we know from finance theory, it may feed back into small companies being able to raise capital better. But this tick size pilot is actually designed to look at market quality and market-making behavior. The structure of the pilot is one where it is a test and control type of pilot. The eligible securities are exchange-listed common stocks, so no ETFs, with a market cap less than $5 billion and average daily volume of less than 1 million shares and a price greater than $2. And a lot of people ask why $5 billion. And yes, we did look at data. We estimated our own data in-house. We looked at effective spreads. The exchanges looked at quoted spreads and came up with the same sort of answer that we did. And if you look at stocks with prices or market cap greater than $5 billion, you don't see a lot of variability in spreads. They're very low spreads, and there's not a lot of variability. Once you go below $5 billion, there's a lot of variability. There are stocks with very high spreads, and there are stocks with very low spreads. When you add the $1 million volume, or what's that, 1 million share volume screen, then you lose a lot of the firms with low spreads. So this is targeted towards firms that do tend to have higher spreads, but their spreads are still highly variable. And there are no IPOs eligible to be in the pilot. It is a 1-year pilot, and it is designed to end at the end of 1 year before decisions are made on how to change tick sizes. And that is by design, and it's not typical of pilots. So that is an innovation in this one. I mentioned before, this is a test and control type of pilot. There are 3 test groups and 1 control group. The set of eligible firms is somewhere around 2,800. And the test groups will have about 400 stocks in them each, with the remaining stocks being in the control group. So this should provide some flexibility in deciding what sort of controls you want to have if you're deciding to test the pilot. And 400 in the test group should provide enough power to test a number of different market structure type of questions. Not a lot of power to see if there's more analysts in the stock, but it should be sufficient power for examining changes in liquidity. So there's 3 test groups. The first test group, the innovation in that test group is just there's an increase in the quoting increment from 1 cent to 5 cents. Currently today there's no trading increment, there's just a quoting increment. And so this would simply raise the quoting increment to 5 cents. The second test group examines whether if you're going to increase the quoting increment, maybe you should have a trading increment. So it would add a trading increment to 5 cents or mid-quote, if that's not on a 5 cents. And there's various exceptions to that trading increment. Test group 3 applies the quoting increment of 5 cents, the trading increment, and a trade at rule. What a trade at rule says is that you cannot trade at the quote unless you are matching the quote in terms of your quoting yourself. If you are displaying a quote that matches the best quote, then you can trade at that quote. Otherwise, you have to price improve. And there are various exceptions to that. The reason to have these 3 test groups is really to focus it on what a regulatory response would be coming out of the tick size pilot. It's not necessarily known that the only thing you should do is increase the quoting increment. There are a lot of people, particularly market participants out there, that think that you need to change other rules at the same time. And so this 3 test group design allows you to test several options for changing the tick size. Another key element that I'm sure a lot of you are very keen on here particularly is data that would be made available during the pilot. So if you're familiar with a lot of the decimalization literature, you know that a lot of the really interesting papers use more than just TAC data. A lot of the papers have some kind of proprietary data. And so part of the proposal for a tick size pilot includes releasing data that would provide better studies of the pilot. So these are also designed to help address the main points that we brought up, which are market quality and market maker behavior. And they're meant, they will be public, and they're meant to supplement already public data. So this doesn't mean TAC is going out for free. So the first set of data is a list of ticker symbols that will be in the pilot group and the control group, and how those ticker symbols might change over the course of the pilot. This is similar to data that was put out in the Reich Show pilot, but in that pilot the control sample was not released. This time the control sample will be released, and you'll be able to see the ticker symbol changes in the control sample as well as the test groups. This doesn't mean you're constrained to the control sample, because we're not dictating what analysis you do if you're going to test the tick size pilot, but it does offer you the availability. The second set of data is, we call it daily 605-like data. So if you're familiar with the Rule 605 data, it's monthly market quality statistics put out by each of the trading centers. This would be the same type of data, but it would be on a daily frequency, still released publicly, but you'd see the statistics daily. It would also include more order types than are currently included in the 605 data, and it would include more order size and time to execution buckets. So there's no longer going to be just a 0 to 10 second bucket. The third type of data is market and marketable orders. And this is meant to supplement and address a few more questions than you can address with just 605-like data, and to supplement the type of limit order data that's available on the SEC's market structure website. The last type of data available includes the number of market makers in each stock each day, and the aggregate market maker participation and profitability in each stock in each day. So you shouldn't be able to determine which market makers are profiting or which ones are participating, but you should see whether that increases, decreases, or how it changes over time. And most of this data will be available monthly, with the exception of the list, which will be available daily. So the status of this is that the SEC put out an order in June that ordered the exchanges and FINRA to put together a plan for the tick size pilot. They put together this plan on August 25th, I believe, and it will go out for public comment very soon. So what this means for you is that if you are interested in studying the tick size pilot and you have opinions on the structure or the data, submit a comment letter to the SEC. There could be changes to the pilot structure or the pilot data coming out of the comment process. It's possible that not all market participants will appreciate the value of the data in particular. So if you appreciate the value of the structure or the data and you want to say how much you like it, feel free to submit a comment letter. If you think it could be improved and you have specific suggestions on how to improve it, submit a comment letter. We'd love to hear from people who want to study the pilot. And I guess with that, I will pass it over to Igor and take questions at the end.
Good morning, everyone. I will be talking about asset-backed securities, and before I start talking about them, let me briefly give you some history, some historical background on asset-backed securities. So Asset-backed securities provide important conduit of capital for borrowers, be those borrowers consumers or businesses. And during these events of 2000s, housing bubble and subsequent financial crisis, those ABS, in particular residential mortgage-backed securities, RMBS, were important during the bubble and immediately afterwards. Some observers claimed that those securities, well, were one of the causes of the financial crisis. So during the bubble, ABS were extremely popular with investors, and a lot of investors bought those securities without considering what's in there, what is backing those securities. Well, when things went south in 2007, 2008, a lot of investors discovered, well, some deficiencies in those securities. Well, in particular, investors discovered that credit ratings of those securities are quite unreliable. Then they discovered that it's quite hard to find out which assets actually back those ABS. And in some cases, it was nearly impossible to track down which specific mortgages or car loans or commercial loans back securities. And finally, investors could not connect to other investors in ABS for some collective actions. Well, why the situation was like that? Well, the disclosure regime pre-regulation AB2 was quite different than regulation AB2 requires now. Well, first of all, well, ABS issuers had to disclose some things about underlying assets. However, those things were only on the group level, just summary statistics about some variables related to characteristics of ABS. And second, these disclosures were buried in hundreds of pages of legalese in prospectuses of ABS. It was very hard to find, to extract this data into, well, database formats which we all of us are familiar with. Well, there were some loan-level information available through commercial providers, and there is some data available now. However, there are some issues with those data. Well, first of all, this data is very expensive. So if you ever used any loan-level data about residential mortgages, well, you know that, well, you have to make a very good case with your DIN to get this data. Second, this data is very noisy and sometimes is very inaccurate. And in fact, in this very conference, we had a paper which documents this result, that, well, data is not as good as we would like it to be. And finally, S-level data was available only about RMBS, only about mortgages underlying residential mortgage-backed securities, but not other classes of ABS. So what does regulation AB2 change? Okay, well, first, regulation AB2 reviews shelf eligibility requirements and changes them quite a bit. First of all, AB2 removes reliance on credit ratings as factor in eligibility of ABS for shelf registration. Second, this regulation introduces new shelf eligibility requirements. Among many requirements, I would like to highlight a few. Well, first, it improves investor communication, and in particular, issuers must provide contact information of investors by request in monthly distribution reports to investors. Then another shelf eligibility requirement is introduction of delay between publication of data about ABS and actual pricing of ABS. This will give investors enough time to actually consider and to analyze that data, and will create some kind of speed bump to avoid well, rush in hot markets that may occur and occurred in mid-2000s. But finally, the most important part of regulation AB2 is asset level disclosure. So regulation AB2 requires asset-level disclosure for assets underlying certain classes of asset-backed securities. And this disclosure has several elements. First, it is public. It will be disclosed in Ether. Second, it is standardized. So all data fields will be standard across all ABS of certain class, and therefore it will allow easy comparability between different securities. Next, this asset-level disclosure applies to several asset classes. In particular, I would like to highlight auto loans, and this will expand the set of ABS which will be subject to asset-level disclosure, and researchers will have access to much larger set of data. Well, and finally, well, because this is mandated disclosure, issuers will be much more careful in ensuring accuracy of the data they disclose. Again, right now, as we learned from a couple of papers, the data is quite noisy. Well, hopefully, mandated disclosure will deliver more accurate data. Okay, so these are elements of Regulation AB2, and now, well, all of you here may have a question. So, why should I care about it? So, you are academic researchers, and I would like to highlight a few things that you, as academic researchers, can find useful in Regulation AB2 and its aftermath. Okay, well, what you can study with this data? Well, of course, we, as academic researchers, love data. New data, we can do a lot of things, and I hope that you will find this data useful. Okay, well, big thing, rating agencies. Well, ratings I eliminate as criteria for shelf eligibility. Well, the big question would be, do issuers asset-backed securities maintain their ratings? Will they buy ratings again? Is there any value added in ratings? So this is a nice case study to see whether, credit rating agencies deliver anything to investors, or they simply ratings are popular simply because they are required by some regulations. And I would like to remind you, as Craig mentioned, that Dodd-Frank actually requires a securities regulator to remove credit rating references to credit ratings in securities regulations. Okay, next, what else can we study about asset-backed securities with all the new data and the new regime of Regulation AB2? Well, we can learn a lot about pricing efficiency of ABS. With all asset level data, we can study a lot more about default rates, about payment histories of underlying assets, and we can do much more accurate pricing of asset-backed securities. And well, we can compare actual market pricing with theoretical pricing, and we can build much better models of pricing of asset-backed securities. And most importantly, we can test those models. And when I say we, I include both us as regulators and you as academic researchers. Capital formation. Shelf eligibility requirements change. And now we can learn about what would happen with capital formation through ABS. Are ratings effective in separating asset-backed securities which should be offered on shelf or not? Are new shelf registration requirements better for capital formation than old ones that create ratings? With that, I will conclude and again emphasize the fact that Regulation AB2 is one of those regulations that may be extremely beneficial to people who thrive on data, and I hope that all of you, or some of you, those of you who work in this area, will find it very useful to use the fruits of this rulemaking. Thank you.
Good morning. So, as in the case of asset-backed securities, Dodd-Frank also mandated significant new rulemaking in the space of credit rating agencies. So I thought I would give you a quick overview of the current status of credit rating agency, I'll call them CRAs for short, CRA regulation, and then highlight some of the challenges that we face in regulating CRAs and some related questions of which we think further academic research would be helpful. So the SEC's oversight over registered CRAs was established only in 2006, and it is a voluntary registration regime. So the registered credit rating agencies we call NRSROs, but there also do exist unregistered credit rating agencies. After the financial crisis, but even before Dodd-Frank, the Commission undertook significant rulemaking in this space. So for example, we adopted rules that were intended to allow investors to compare the performance of ratings by different NRSROs by requiring them to disclose credit rating histories for a sample of the ratings that they had outstanding, certain kinds of subsamples of those ratings. We also adopted rules to promote the issuance of unsolicited ratings on asset-backed securities, partly in response to this idea that the ratings for asset-backed securities seem to be particularly unreliable, as Igor was mentioning. And what we did there was to require that the information that was provided by an issuer to the hired NRSRO had to be posted to what we call a 17G5 website, which could be accessed by these non-hired NRSROs, which would allow them to produce these unsolicited ratings. Dodd-Frank in 2010 then required us to take additional action in this space, and we have now completed a majority of this additional rulemaking. For example, among many other things, we have removed the exemption for NRSROs from Reg FD, and we've been adopting at a very good pace a number of rules to remove references to NRSRO ratings in federal securities laws. And you may know that many other agencies and organizations are doing the same in their rulemaking. Now, at the end of August, we adopted a large package of rules to address some of the remaining Dodd-Frank requirements. And they were primarily intended to do two things: to enhance the integrity of rating procedures and methodologies, and to increase transparency. Among the rules targeted at integrity, there are new requirements that NRSROs assess the effectiveness of their internal controls, that they prohibit staff that are involved in determining credit ratings from also being involved in sales and marketing activities or from being influenced by those activities. And NRSROs are now also required to review their ratings and revise them if appropriate when and if a ratings analyst leaves the rating agency to join the rated entity. Again, these are just a sample of the rulemaking in that area. But among the rules designed to enhance transparency, again, among many other things, NRSROs are now required to disclose transition and default statistics, which are now more standardized in terms of the required computations and required format that's to be used for those disclosures. They're also required to make publicly available credit ratings histories for all of their outstanding ratings instead of just subsamples of those ratings. And they now have to provide a form with each rating action that will include some very detailed information about things like how that rating was generated and what the information content of that rating is. And in the case of asset-backed securities, they're also required to attach certifications that will be provided by any of the third-party due diligence providers on those transactions. So what this last group of rules means is that over time, a lot of new data is going to become available. In particular in these forms, the kinds of things that need to be disclosed by rating agencies are some of the main assumptions that they're making and what they think the key risk factors for these ratings are. They also need to now disclose whether or not this particular rating is paid or unpaid, and whether they provide any other services to the persons that are paying for the rating. That's something that was hard to discern before this was made a requirement. I also mentioned the certifications of the due diligence providers, and there I think there will be really a wealth of information because these have to be attached for all rated ABS, whether public or private, and they'll include very detailed information on what was reviewed, how the review was conducted and a summary of the findings and conclusions of the review. So hopefully there's a lot that can be done with that. I also mentioned these ratings histories and the performance statistics. And we do have access to information about ratings data from other available private sources, but I think some of this new public data will help to supplement those sources. So for example, there will be more information now on withdrawn ratings, which may or may not have been available in some of these other sources to date. So using all of this data, and including what's going to newly become available and what's already available, I think there are a lot of important and very interesting questions that can be addressed. So as Craig mentioned, credit rating agencies are kind of a laboratory for a lot of fundamental questions that we have in finance. On top of that, with all these changes happening right now, I think it's a really good time to use this laboratory to study some important things. But if I focus on those areas that are most useful to our work, then I would say that we face at least 3 main challenges in regulating credit rating agencies. The first is to really understand the market failure that could be at play here. So a lot of people are very focused on potential conflicts of interest in this space, and some of the recent rulemaking has been targeted at that area. But there is some literature suggesting that the regulatory reliance on ratings contributed more to the distortion of ratings than the question of who paid for those ratings. But this, I think, remains an open question. And so some of the things we'd like to understand are, we are moving on removing references to ratings, but we'd like to know what are the side effects of doing it, and how far does the removal of these references take us towards a more well-functioning market for ratings? And that brings me to the second challenge, which is that the fundamental structure of the ratings market really complicates our goals in regulating credit rating agencies. So, for example, we need to think very carefully about how to promote competition in a space where competition for market share could actually lead to inflated ratings. We now hope that promoting unsolicited ratings through, for example, these 17G5 websites will help to keep the hired NRSROs honest. However, in the past, we've also thought about unsolicited ratings as potentially a form of extortion, where the rating agency says, look, if you don't hire us, we will produce an unsolicited rating that will not look good. So again, this is another open question. What is the value and what is the effect of these unsolicited ratings? And some of the new data should help to address this, because now, for example, we have this indicator of whether or not a particular rating was solicited or unsolicited. So it should become a cleaner question to study going forward. And we'd really like to understand more about this. We're also now trying to promote competition on the basis of reputation of these NRSROs through some of these enhanced disclosures. And by making some of the disclosures more comparable across NRSROs, so that investors can more easily discern where these reputations may be coming from. This, in fact, this in turn leads to more questions. So, how is reputation gained and lost in this space? This is not something that we understand very well, and it's unclear whether some of the larger credit rating agencies have, in fact, lost a lot of their reputation throughout the financial crisis, because they've remained some of the main providers of this information. So what is the speed at which reputations can be formed and lost, and what are the triggers that we should be aware of? We would also like to understand more about the role of investor-paid rating agencies, and in general, the role of new entrants in this space versus the incumbents. Another question regarding competition is that, again, we're requiring these disclosures to try and enhance competition on the basis of reputation, but by requiring all of this additional disclosure, we're not sure if we could be overly burdening smaller NRSROs, and that could in turn hurt competition. So yet another question worth looking into. The final challenge that I would bring up, and it ties well into that last point, is that this is a voluntary registration regime. And so at some point, if, let's say, disclosure does become too burdensome, an NRSRO can choose to deregister and become just an unregistered credit rating agency. This is something where it's particularly concerned about now, because as we're increasing the cost of being a registered NRSRO, we're also decreasing the value of being a registered NRSRO by removing these references to NRSRO ratings in federal securities laws. So one thing that we'd like to better understand is there a value to this NRSRO certification beyond these references in securities laws? Is there something about the stamp provided or the disclosure that's required that does generate additional value? Again, if that's something that people could look into, we'd be very interested here. And with that, I will turn this over to Scott.
We'll see if this reaches. Thank you. What I thought I would do is talk a little bit about the quantitative risk assessment programs at the Commission. As Craig said, this is relatively new for the Commission. Historically, for the past several decades, economists at the SEC have conducted economic analysis for policy purposes and also for litigation economics, litigation support. Quantitative risk assessment, by comparison, is only a few years old, and a lot of the progress we've made in this area is in direct response to Craig's involvement with these programs as chief economist for 3 years until he stepped down last May. So a lot of the credit to what I'm about to say, I think, goes to Craig in this area. And before I talk about a risk assessment program, there's one important thing to note which makes the SEC different from other regulators, and that is that we are not a merit regulator like the OCC, the Fed, or the FDIC. We're a transparency regulator. And what that means is we are not so much concerned about the level of risk in the market as much as the accurate conveyance of that risk to potential investors. And that makes us very much different than other regulators. So as long as a market participant is accurately conveying the level of risk in a particular security or investment opportunity, then we think it's appropriate for investors, according to our mission, to be able to make an informed decision on whether or not to invest. And the way we do that is help promote that is by writing rules. In those rules, we give guidance to market participants in different areas, whether you're an investment manager, corporation, broker-dealers. Sometimes that information that's required to be disclosed goes to the market in a form and filing that you'll find on the EDGAR system. Sometimes it's information directly reported to us that we use in a private capacity in order to help monitor and maintain markets. And the second way we promote transparency in markets and enforce is through enforcement of the rules. And this is when we take action when market misconduct is observed. And we typically do this in two ways. One is through tips and complaints that we receive at the Commission. If you can imagine, the market often sees market misconduct before a regulator does. Former employees, disgruntled employees, estranged lovers, clever analysts will often disclose something through our, we call it TCR, tips, complaints, and referrals system. That we get thousands of these every month, and we process them and try to look to see which ones might be actionable in some way. The other ways that we enforce the rules is through our supervisory activity, where we actively go out into markets and try to assess risk. Each of the offices, or many of the offices and divisions at the Commission, have their own supervisory activity. This can occur within enforcement. It can occur within a particular division like corporation finance when they review financial statements. We have an Office of Compliance, Compliance Investigations and Examinations. Did I get that right? OC? Yes. Yeah, there we go, sorry. I'm so used to acronyms, I sometimes forget what they stand for. And I have 1,000 strong employees that go out and do examinations every year. And what we've done recently in our quantitative risk assessment program is we've had two broad objectives. And the first is to identify measurable risk factors to help monitor market participants and help focus SEC resources and prioritize examinations and investigations. If you think about it, there are thousands of market participants, and there are not enough people or examiners available to go look at each one. So is there something that we can do through quantitative risk assessment that would help prioritize those examinations? Who should we look at first? Who should we look at next? Who can wait in a review program? The second thing that we do is once it's decided who to go investigate or examine, is to help those examiners, investigators focus their energies in particular areas. So can we help them look at particular items at a market participant or a registrant, and help them focus their review to particular items and make their time more worthwhile. So how do we actually do this? So what do we do to help our examiners and investigators do their job more effectively? And a lot of what we do is actually borrow very heavily from academics. So all that you do, the models that you develop in your various areas, we borrow that and we try to apply that to the practice. And it might be simple as using an asset pricing model to measure abnormal returns. One of the earliest successes of our risk assessment program was what we call the Aberrational Performance Inquiry, API model that Craig referenced. And all we did there, it's very simple. We took hedge fund self-reported returns and we controlled for strategy and other factors, observed their time series of alpha, looked at those sets that had persistently high alphas and said, perhaps we should look at these next. And just by doing that very simple analysis, we had more than a 10% hit rate of hedge funds that were actually mismarking their assets and were engaged in misconduct. And very quickly demonstrated to the commission how a very simple model can generate very powerful results. That was parlayed into building accruals models, and this is really Craig's baby. Some of you may have heard of the accounting quality model, known as the AQM. And here what we did is we borrowed from the accounting literature to estimate accruals, discretionary accruals, how managers and companies are recognizing revenues and looking to see, are they doing so in an aggressive way? And if so, is this a company that perhaps merits further review? And what we learned in engaging in this type of examination is that there was even lower hanging fruit that we could pick as well, and that is just giving very simple stylized statistics and facts in a particular aggregated format. And we built a dashboard tool for investigative and review staff to help analyze registrants. And some of the things that they can now do is, for instance, if they're reading NDA, a narrative disclosure in a 10K, for instance, or a 10Q, and the company's talking about risk factors and liquidity risk, we can put next to the narrative disclosures some actual measures of what their liquidity is relative to their peers, for example. So we can match what they're saying to actual quantitative measures of their performance or characteristics of a registrant. And so that's been a very powerful tool for the Commission. It's currently being used by the Enforcement's Accounting Fraud Task Force. It's also being evaluated by the Division of Corporation Finance's Review Program, where they have 400 to 500 accountants and attorneys that review registration statements as they come in and provide comment on those forms and filings. And the last area that we've made some significant inroads is in the broker-dealer risk assessment space. And here, we're again using very simple models, particularly focused on operational risk and information that comes in through focus reports and filings to look at how particular registrants compare to their peer firms. And if we look for deviations in certain metrics that are recorded and how far away they are from their peer firms, and then look at how many deviations they have and just create a simple scorecard that again allows our Office of Compliance and Examinations to go out and prioritize the review program or focus on particular areas for which they have particular deviations. Now, so those are three areas, hedge funds, corporate issuers, and broker-dealers. We have in place quantitative risk assessment programs that have surfaced in the past few years where we've demonstrated how academia could really, in models developed in academia, can help the enforcements of review programs. One of the challenges that we have is in the false positives. And as you all know, with any model that you build, you will have a lot of false positives. And so the educating of review staff and setting expectations that, if you get a list of 20 companies to look at, the likelihood that you're going to find, 10 or 15 problematic firms that have, were engaged in misconduct is relatively low. But you might find a couple which is going to still be a greater hit rate than if you were just randomly looking at 1,000. So that's the kind of the point of, or one of the challenges that we have in educating the review staff. And I guess I'm going to close here in the last minute to kind of do a little bit of plug for how economists work at the SEC and how we're a little bit different than academia. We've always considered ourselves quasi-academic. And if you ever recruited with us and interviewed with us, we'll tell you something like, we're like academia, where you do research, you have your own individual research program, self-directed, in areas of interest to the commission. Instead of teaching, you'll work on policy work. Now we also have a sales pitch which goes something like this. You can engage in your own research program on SEC relevant issues, published just like you would academia, but instead of working on policy, you can work on catching bad guys. And so if you're doing asset pricing, for instance, you can help develop models that will detect market misconduct, work with enforcement, work with OC to help engage in better monitoring or surveillance of markets. So I have no more prepared remarks. I'm going to turn it back over to Craig, who's going to open up the floor and may offer some last comments before he does that.
So I want to thank all the panelists for participating today. It gives you a little better insight, I think, into the various activities that actually take place in DERA and how involved economists are and are becoming increasingly involved in actually some of the processes that take place in the commission. I think this has been a great period for financial economists at the SEC, and it continues to go in that direction.